Good evening, peoples. Let's jump in here for Misty and MSTR. All right, like Coney, it's a pretty big down day, 4.41% on MSTR. And because of it being ex-dividend date, we were down 11.92, almost 12, right? So the $1.85 is what came out of MSTR, and the rest was because MSTR was down, or sorry, they came out of MSTY. All right, so we had several trades go on. Of note, they did a synthetic. I can show you some of this stuff on a separate sheet. Hold on. Let me get that up here. Okay, so this is what it looks like. They closed out some positions here in their 139 synthetic. So instead of buying a call to open a new position, they sold since they're way below, right? They're down at 114. You can see why out till October 18. They had to pay 29.90, right? So that's losing money. That was about 3.7 million. And then they bought to close a couple of small amount of contracts and then added another um, small amount of contracts, all still on the 913. So that's the current weekly. So this is kind of what it looks like. They did make some money, and on writing these, they still have a very good chance of winning all that. So their weekly looks, let me clean this up. Hang on just a second. So it looks like this. This is 33,815, and these are all at the 132 mark. So they're 10.4 away from those guys. These are no longer active. Okay. So 10.5 or 10.4% with 5 trading days to go, right? And this needs to be updated. This equals, because I have a new tab now, September. So we're at 1900. Whoops, that's not the one I want. I want this one to be MSTR, not Misty. Okay, and this one I want it to be Misty. Okay, so we got that right now. So we're 15% away, right? Because we're trading. That's $18 on $114. So we're looking pretty good. Plus, we've captured, I think, 67%. I'll show you when we get over to holdings. But we are losing. We're up to 82 million, I think. Let's jump over to holdings. Yeah, we're 80 million. All right. So we did add a little bit of shares, I think 125,000, but we're down. That's so this 80 million is up from 62 million, right? Actually, did I do something wrong? Yeah, I made that should only be 80. Hit the wrong key. Okay. But it's still pretty ugly on that. So what did we close at? 1907, and what is fair value? 1903. So pretty close there. And we've captured 64% already of this guy, right? Because we had sold the bulk of those up in the high twos or low threes. So we look pretty good, and we're 15. The main reason is we're 15% away, right? When you keep dropping. So this represents about $3.69, something like that. Um, So we'll take a look in a minute on that and see how we look. Um, I left these here because these were the ones that we closed back earlier, like 9.5 or 9.4. I think it was 9.5, where we closed all these out. So we had a brilliant week there. So again, if you're synthetic, right? If the underlying is just dropping, 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 then your NAV is going to drop, drop, drop. You're going to win your weeklies, but they don't really offset the amount of money you're losing, right? Because they're limited. They're just, whatever, how far you wrote the call out, you collected 7 million, 9 million. Well, your synthetic, when it goes down, it can go down 20, 25, 30 million in that week. So you're never getting ahead, right? That's, think of it as a growth stock. If I tell you to go out and buy Microsoft and I tell you to buy it at 400 and it drops to 300, there's no way that you didn't lose 25% of your investment, right? 400 to 300, one fourth, 25%. It's just math, right? Here, you might lose 21% or 22, depends on how long it took it. And so how many weeks of income did you collect, right, to sort of offset the drop? And so you generally, when selecting an income fund, always want to be bullish on the underlying. Now, some of you look at S&P 500, you want to go look at round hills. And I agree, over the long term, many years, the S&P 500 is going to do just fine. It's going to average, 7, 8%. But it's going to have years where it goes up 35%, where it goes down 22%, where it goes up 2%, goes down 1%, right? Whatever they are, they're all going to add up to an 8% up cycle. So there's nothing wrong with that. But understand, you can be, you can have a decade of down. I mean, I'm not saying we are. I'm just saying, for me, I see better assets than the Dow or the S&P 500 or the Nasdaq over the next 5 to 8 years. They're going to be in certain commodity kinds of plays, right? But that's not something that's going to sustain itself for 20 or 30 years. So just to always be aware of your investing. You can go out and, because you love weekly pay, and you can jump in and buy, QDTE for the Nasdaq, or you can buy XDTE for the S&P 500, and you can have a negative return, right? You may get a 25% yield with a 29% NAV reduction. I mean, there are periods of time that happens. So don't just think that the fact that, you're looking at this year to date. I imagine the numbers still look pretty good, but don't forget that we still have to survive September. I think this next week will be really interesting. Um, and then when you have certain asset classes, right, like BTC, I think that does very, very well over the next 6, 8, 10 years. That doesn't mean that it doesn't run from, mid 50s to 125 and turn around and go back down to 70, 74. And that's just those peaks and valleys. But you want an uptrending asset class that you choose for an income fund. Otherwise, you got that real NAV deterioration, right? NAV decline. And I get it. I thought it was great. I remember my interview with Will Ryan, the CEO. We talked a little bit about that. Think about when you go into retirement, um, think about an annuity. What is it? Well, it's taking a bunch of your money, a bunch of your assets, and giving it to, if you will, an insurance company, a brokerage, whoever manages it. But typically it's insurance companies, and they look at all these tables and law of averages, and they say, okay, you gave me a nest egg. I don't care what it is. Say it's $800,000, and I'm 70 years old, and I think, my life expectancy is another 18 years or 20 years or something. Um, And then I say, okay, well, I gave you 800,000, you're going to give me back 40,000. So they have all these tables and they calculate how they're going to give you 40,000 a year, and they're going to break the 40 into monthly payments. And you talk about NAV erosion, that's exactly what happens. That nest egg doesn't stay as big. The idea is that you live long enough to get all your money back. You may have a small amount left, right? Because it is earning interest, right? They're investing it to some degree. All right, guys. So, but if you're an active investor and you're watching things, you can seek yields or yield return that's higher, but not without risk, not without risk of NAV erosion. You just have to try to choose the right assets that aren't going to be in that category of NAV erosion or as much NAV erosion, right? Nobody's going to pay you 70% and have 100% doubling in the asset year after year after year. You could have that for 1 year. I mean, then you'd have 170% return, right? They gave you 70% yield return and the asset doubled. But the minute you start thinking that's a 5, 10, 15, 20-year progression, good luck, right? We all would love to have that, but highly, highly, highly unlikely, improbable. Okay, so let's finish up here and look at payouts. So we got 3 million loss, right, when we took the 139s off the table. And we still have a lot of them. We still have 33,815. So we either eventually get up there in MSTR or before October 18th, or they're going to lose a lot of money along the way. And but the other good news is we're writing these calls, and as we drop, we're going to win these. So right now we've got 32 cents in the kitty because of that. Now, all we have to do is stay below 132, and we're at 114, right? All right, so that's what I got for you, peoples. No call spreads here, right? Remember I brought up Coney? So I'm going to fix my tracking spreadsheet where I break both synthetics, naked weekly calls, or what we call weekly calls, and then I'll create a bucket for the spread so you can see how they're doing by grouping them into the pairs, right? So it depends on the spread on whether you're doing a bull spread or a bear spread. But they're always involve two calls, the buying of a call and the selling of a call. You just reverse the order, right? In a bull, you buy the low and sell the high. In a bear, you sell the low and buy the high. So it's it's similar but different. Okay, guys, and I'll educate you a little bit more of those, and I'll look for those in some of the other funds that I'm going to cover. Have a great rest of your weekend, peoples. Again, this is Bruce with Targeted Wealth Creation. I'm not a financial advisor. This is not financial advice. Have a great rest of the weekend. Bye for now.